Welcome, everyone, and thank you for joining us for this federal budget webinar. My name is Dermot Reiter. I'm a senior financial advisor here at Apt Wealth Partners, and joining me today is my colleague Tracey Pace, who's also a senior financial advisor here at Apt Wealth Partners. Tracey's been through many budget cycles, so she's well versed in what we need to be speaking about today. And if you've worked with Tracey before, you'll know that she's got a real knack for translating the technical detail into really clear, actionable advice. So she's going to help me break down some of the key elements of the budget and explain what it really means in practical terms. We're very fortunate to have Tracey to share her insights today. Welcome, Tracey.
Good morning, everyone. It's a pleasure to be here, Dermot.
And it wouldn't be a webinar without the usual general disclaimer. The compliance team has asked me to provide just this is obviously not personal advice, and there's going to naturally be some conversations that you're going to need to have with your advisors to really get that personal advice. But it's a general in nature. We're just talking about these proposals, and I think it's also worth pointing out that what we're discussing today, these are budget announcements and proposals only, so they're not yet law. And obviously, there's going to be a legislation process that the government's going to embark upon to get these things through. So just be aware of that. There's a little bit of water to flow under the bridge, but it looks like a lot of these changes are going to be adopted given the mandate that Labor has. And housekeeping, before we get underway, if you have any questions along the way, please feel free to use the Q&A box in the Zoom menu to submit any questions during the presentation. So we'll try to get to some questions at the end. And also, there's a recording if you want to go back and listen through any of the elements again that we made available after today's event. So without further ado, the agenda for today, we really want to just focus on the tax reform aspects of this budget because they're the parts that are really going to have the greatest impact on our clients' outcomes. So today we're going to explore how the capital gains tax rules work, what the changes to the negative gearing measures mean for property investors, how the new 30% minimum tax rate will be applied to discretionary trusts. Then we'll highlight throughout some different examples and strategic planning considerations that arise from these tax reforms. And we're in the early stages of that, but there's a lot of different strategies that we can start to put together over the next couple of years before some of these rules take effect. And then we'll take some questions at the end. So getting right into it, the first major change is on the capital gains tax front. This is the biggest technical shift in this budget, and it's going to affect investors, business owners, and family groups quite substantially. So in simple terms, really from 1 July 2027, so we've got a bit of time up our sleeve, the current 50% capital gains tax discount for assets held more than 12 months, which is the current regime, will disappear for assets owned in individual names, trusts, and partnerships. So instead, and moving forward from 1 July 27, we're going to move to an indexed for inflation using CPI. So your cost base will effectively increase with the indexation rate, which will be quoted by the government. And then in addition to that, there'll be a new minimum 30% tax rate that'll apply to the net capital gain. So these rules, they cover all capital gains tax assets. So that's property, shares, and interestingly, they even include pre-1985 assets. So the 20th of September 1985, those assets had been previously exempt from capital gains, and they will, up until 1 July 2027, the gains up until that point will continue to be exempt, but moving forward, any growth beyond that point is going to be in this new regime. So if you buy and sell an asset before 1 July 2027, nothing's really going to change from that perspective. But assets bought after 1 July 2027, they're going to be taxed very differently moving forward. And that's where that CPI index cost base is going to be imposed with that 30% minimum tax rate. So this is very significant change and throws up a lot of different planning opportunities in terms of the merits of owning property, what capital growth prospects you're expecting from different assets. And so this is really where our advisors, we earn our keep in working out what is the best strategy for each individual client. But importantly, the growth up to 1 July is still going to get the 50% discount. It's just that growth after that point, which is going to be subject to these new rules. So in terms of working out that split, um, getting a valuation as at 1 July 2027 is looking like it's going to be a path that a lot of particularly property investors are going to need to go down that path to get a good valuation, and hopefully a very fair and high valuation to reduce the future tax on that. But the ATO is going to provide a formula and some online tools to assist with that as well. But we'll get into the detail of how that works. So, Tracey, that's the framework in theory, but can you just walk us through an example to maybe sort of bring some light to how this might play out under the new rules?
Sure thing. Yep. So to give you a feel for the numbers, we'll run through a bit of an example to show how the new rules could potentially increase an individual's tax bill. Here we have Jane. She buys an asset, could be a property or could be a parcel of shares. She spends $800,000 in 2022 or spent it, and sells the same asset in 2032 for $1.6 million. In both systems, the capital gains is the same. It's an $800,000 gain. Under the current CGT rules and with a 50% discount applied, Jane would incur tax of $400,000 on that gain. Under the new split and the indexation rules that Dermot's just explained, Jane can make use of the current 50% discount on her gain from 2022 through to 2027. And then at 1 July 2027, she'll need to get a valuation on that asset. Now, if it's a share, obviously it's at the market price on that given date. If it's a property, to Dermot's point, the need for a proper valuation will be required. From a tax point of view, what does that mean? We've made some assumptions around sort of CPI over, the future date, which would be 2027 through to 2032. And we then assume that her cost base, or her profit actually, is $485,000 versus the $400,000 that she'd otherwise would have been assessed on. So from a tax point of view, she goes from a tax bill of $188,000 under the current rules to $228,000 on the assumption that she's obviously paying tax at the highest marginal tax rate. So despite this sort of being framed as quite simply taxing inflation gains, for most long-term investors, they're going to see an increase in their tax bill relative to the current. Should note there's a couple of exceptions. There's a specific carve out for new build residential property. So investors in qualifying new builds will be able to choose between the 50% discount or the new indexation 30% minimum tax combination. Importantly, and this definitely pricked our ears, but super funds are not caught up by these changes. They retain their current 1/3 capital gains tax discount for assets held for longer than 12 months, and company structures remain outside the personal CGT discount regime as well. From a planning point of view, if you just want to hit the next slide, thanks, Dermot. From a planning perspective, there are 3 key questions to ask about your portfolio. Should I rethink when I realise gains? The old strategy of waiting until you have little or no other income to sell an asset is less powerful. Once a 30% minimum tax rate applies to realised gains, unless you qualify for income support exemptions, that is essentially off the table as a consideration after 1 July 2027. Am I comfortable with my cost-based evidence? For assets you expect to hold beyond 1 July 2027, you'll want good records and, in some cases, professional valuations on file so that the pre- and post-2027 components are calculated fairly and accurately. Dermot and I joked that valuers would be rubbing their hands together at this point in time. Are my assets in the right structures? Because individuals and trusts lose the 50% discount while super retains its 1/3 discount and companies are largely unaffected, as advisors will increasingly be comparing personal ownership versus super or company structures for new investments. For small business owners, this means we'll need to take a look at the small business CGT concessions, particularly the retirement exemption, as changes to the CGT discount can materially change client outcomes. Back to you, Dermot.
Yeah. So there's a few things on that that are also interesting little planning opportunities on the small business side of things. You're right, Tracy. It's really, we need to go back to the drawing board in terms of, because that's a big retirement planning strategy for a lot of business owners. Their legacy and what they're wanting to retire on is really built into their business. But there is a 3-year rollover relief window up until 2028. So we've got some time to work out, do you need to restructure into a different entity? Do you need to change? Is there a succession planning option there that needs to be triggered? So there's a lot of things that need to be done, and there is some time to do that. The other thing is interesting with that carve out and the exceptions around the new property. It was interesting to learn that it actually includes if you've like downsizing or um, knocking over and rebuilding, but you're putting more dwellings on that block, that's considered as adding to the supply of new housing, in which case you still get the 50% discount. So there's some interesting little nuances and potential opportunities if that's a path that clients want to go down to downsize the family home and put 2 or 3 units on the block.
Yeah,
You
yeah.
still might be exempt. So yeah.
Just a couple of questions have come through, which I think we might just knock on the head now. The first was to clarify if the 50% discount is removed for gains after 1 July or only assets acquired. So to clarify, the timeline that we're looking at is essentially if you hold an asset now through to 1 July 2027, you get to keep the 50% discount for that passage of time. And then you fall into the old pre-1999 sort of version of indexing your cost base from 1 July 2027. So hopefully that helps clarify that. And the second question I'll let you answer, Dermot, but the example that I gave spoke about a 47% marginal tax rate. And the question sort of relates to, but isn't tax being set at 30%? So did you just want to clarify that we still have to work within the bounds of marginal tax rates?
Yeah, that's right. So it's essentially there's going to be a minimum of 30%. So it's essentially if you're a 47% tax paying entity or individual, then that's essentially going to be the tax rate that you're going to pay, unfortunately, on those net gains.
Yep.
But they're saying more so for people that are less than 30%, they're going to impose that minimum of 30%. So in the unlikely event that you have a big capital gain event and your marginal tax rate is still below 30%, they're going to just impose the 30% regardless. So hopefully that addresses that. But I think the key takeaway here is that the capital gains on personally held assets will generally be more heavily taxed into the future compared to the 50% discount. Most scenarios result in that outcome, particularly over longer holding periods. So the opportunity here is to use this transitional period to tidy up legacy assets, work out what assets you might want to keep or get rid of and restructure based on today's rules, what makes sense. And then obviously look at, what expected returns do you have for each asset moving forward, and the structures that they should be owned through moving forward, I think is really important. So the other major consideration with the second pillar of this budget really was centered around the negative gearing reform. And the government really drew quite a hard line between established property and genuinely new housing. And I think that plays into that narrative around creating more supply. And it really does fit in with the CGT changes. They're trying to pare back the tax breaks for more speculative leveraged investment into existing housing supply and provide more incentives for investment that adds to supply. So that's where the new home exemptions come from. So just to be clear, from 1 July 2027, negative gearing on established residential properties is effectively quarantined. So you'll still be able to have, if you've currently got a negatively geared property, you can continue to negatively gear it into the future. You'll still be able to deduct your losses, but and you'll still be able to do that moving forward on those existing properties. But moving forward, that's going to change from 1 July 2027. Negative gearing on established residential properties will effectively only be able to be deducted against residential property income. So if you're running at a loss, you won't be able to offset it against your PAYG or wage income. You'll only be able to offset the costs of that property, and in particular the interest, which is the major cost of running an investment property, against rental income. So that really changes the game as to the narrative and also the motivation for investing in property. But importantly with these changes, it only applies to residential property investments. So geared share portfolios and even commercial property is not affected. So in terms of asset class selection, that'll be interesting for a lot of clients. And it effectively means these transitional rules, there's going to be three different tax treatments for different properties. So there's going to be your legacy properties, as I mentioned before. If you held any asset up to budget night that was negatively geared, including contracts that have been exchanged but not yet settled, so contract of sale date, it keeps the old negative gearing rules until you sell, and then the person that acquires that property won't be able to negatively gear that. Then there's these window purchases. So properties bought between budget night and 30 June 2027, they can be negatively geared up to 30 June 2027, but then moving forward, they'll shift to the new quarantine regime. And then post 1 July, all new purchases are going to not be able to be negatively geared against non-property income. So that's broadly the framework that we've got. Some major changes here. Obviously, Tracey, can you bring it to life for us in terms of just a real life example of what it might mean for a typical client that's pretty highly geared into a property?
Yeah, absolutely. So in this example, we have an investor buying a $900,000 established investment property today, and they've got a high loan to value ratio with their lending. Under the current rules, a $15,000 rental loss could reduce their taxable salary and wage income each year, saving up to, say, $7,000 in tax if they're on the highest marginal tax rate. Under the proposed rules, that 15 grand loss can't reduce their pay-as-you-go income. It can only offset rental income to make it neutral, and then essentially be set aside to be offset against future property capital gains. So it is a very different type of regime. The total tax outcome may still be similar over time, but most of the benefit only arises at the point of sale. So delayed gratification required here, rather than helping with cash flow along the way. To be frank, for investors with higher levels of debt, that can change from a timing perspective alone. It can be the difference between whether a property feels manageable from a cash flow point of view, or if it just puts too much pressure on cash flow because the individual's needing to find the gap and fund it themselves. Importantly, to your point, the new build residential properties are treated a bit differently. So they can continue to be negatively geared both before and after 1 July. Again, trying to emphasise the need for supply to improve. And there are also those important sort of structural carve-outs. So widely held trusts, such as many managed property trusts, super funds, again, including self-managed super funds, are exempt from these negative gearing limits. So from a planning point of view, considerations, if someone is gearing, is my gearing level actually still appropriate? With losses now essentially quarantined and deferred until the point that you sell the asset, higher loan to value strategies that relied more on reducing your pay as you go assessable income, it now carries more risk. For some clients, this means reassessing how much debt they're comfortable taking on and the type of property that fits their situation. Do I want exposure to new builds, and at what risk? While new builds may offer extra tax incentives, the underlying risks don't change. Things like location, potential oversupply, build quality, and developer risk still matter. In other words, we don't want the tax tail wagging the investment dog. We still want to come back to the value of the asset at the end of the day. Should some properties sit in different structures? And this is where I suppose our remit lies. Because self-managed super funds and widely held trusts are exempt, we may see a natural shift towards some residential property exposure inside super or through listed or unlisted property vehicles rather than in personal names. Having said that, this brings its own considerations around diversification, liquidity, and borrowing limits. It's not as straightforward as as it might otherwise seem.
Yeah, that's right. I mean, buying residential investment property and gearing it through super has a whole host of other compliance risks and other loopholes and things that you've just got to jump through to actually get to that outcome. So it's not that straightforward. But I think, new builds, it's a completely different asset class, isn't it? Compared to established properties, because often you're looking at areas that don't have the infrastructure investment, they don't have the return data historically to work out, is that a good area to invest in? Am I going to, get rewarded by way of capital growth? So I think it really needs to be carefully thought through in terms of what your property investment
Yeah,
portfolio
yeah,
strategy is, and then maybe preserving those properties that are negatively geared, because it may not get better when you actually sell and reinvest in this new world. It might be better holding those assets that preserve those negative gearing benefits. So I think the key takeaway really here is the government hasn't abolished negative gearing, but it's certainly significantly narrowed the benefit for new purchases. Um, and in personal names, that's going to be where it's the biggest impact. So we need to really rethink leverage, what property you own, for what reasons, what structure that property is owned in, and we have to have a really good lens around what are the expected return profile around rent, capital growth, and be able to model that out clearly, because the tax incentive was obviously a big thing for investors, and that delayed gratification point is important, is because it's still there, but it will be just at the point in which you sell. So you don't get that ongoing annual tax benefit from the negative gearing on new properties. So that's a significant change for a lot of our clients with property holdings. And the third major budget reform was around discretionary trusts. And we know that a lot of our clients use trusts, particularly business owners, hardworking professionals, and family groups to build wealth. But from 1 July 2028, they're going to impose a minimum 30% tax rate on all taxable income of discretionary trusts. And this will be paid by the trustee, so the person responsible for managing the trust, essentially. And the beneficiaries of that, and this is individual beneficiaries, so not a corporate beneficiary or a bucket company as it's otherwise known, they will still include their trust income in their tax return, but they'll get a non-refundable tax credit for the tax that's already been paid at the trust level. So effectively they'll get that offset in their tax return, and so they don't get hit twice. But essentially, in practice, this means that 30% minimum tax rate is a starting point for discretionary trust income. And for some families that are on that tax rate or higher, on the top marginal tax rate, this might not have much of an impact. But for those that use either franking credits, or other beneficiaries that are on lower marginal tax rates than that 30% threshold, it really does significantly reduce the tax planning benefit of this structure quite substantially. And they've closed some of the potential planning opportunities around franking credits, which is where you're investing in companies that are getting a credit for the tax that they've paid at the Australian company tax rate of 30%. So they're disregarding that effectively, so that you're having to pay a 30% tax rate, regardless of any franking credit benefit that might reduce below that 30% effective tax rate. So these are pretty big changes in the nature of how trusts are used, Tracey. So just to bring this into tangible focus, are you able to walk us through an example to show us what that actually looks like in practice?
Yeah, I can. And this one, I'm not sure that we have a slide for it, so I'll sort of talk through it if you can
Yeah.
sort of picture this in your mind. But take a family trust earning $200,000 from business or investment income. And previously, it was quite common to distribute that income amongst several adult beneficiaries and potentially take advantage of those with some lower marginal tax brackets or sitting in lower tax brackets. Under the proposed changes, the trustee effectively starts from a minimum tax rate of around 30%. So any franking credits essentially will be offset against that initial 30%. Not dissimilar to companies, actually, if you contemplate that they've actually got to pay the tax and then distribute a dividend out to the end shareholder with a tax credit attached. And that's essentially what's going to occur here. The difference is franking credits can get refunded. This tax won't be refunded. So it'll essentially sit on the individual beneficiary's return as a separate source of income that has had tax paid on it. If your marginal tax rate is greater than 30%, you'll pay a difference in that tax bill. If your marginal tax rate is under 30%, it's the tough rule. The 30% minimum will have been applied and will apply to you. So to your point, Dermot, it doesn't make family trusts necessarily redundant, but it does change, I suppose, our client conversations. The focus might move away from, how we perhaps maximising return / minimising tax in any given year towards a slightly bigger picture question, which is this still the right tax structure for us to utilise moving forward? Have we actually established it more from a control point of view, or with succession planning and fair wealth creation, intergenerational sort of discussions at the fore of our minds? If not, if we were really just using it for its income splitting capability, maybe we're having a little more of a nuanced conversation around, a potential restructure. Your slide actually just sort of speaks to some of the exclusions. So under the proposal, the 30% minimum tax isn't intended to apply to things like fixed trusts, widely held trusts, superannuation funds, special disability trusts, deceased estates, or charities. But one very important, I suppose, side effect, which maybe the government actually knew that this was actually going to have an impact, but it's one that has really come to light for us in the last 24 hours, is the notion that existing discretionary testamentary trusts, so trusts created following the death of someone, included as a provision in their will, they're expected to remain excluded. But any new discretionary testamentary trusts set up in the future are likely to fall under this 30% minimum tax, unless we see some change or some wriggle room around that rule. So to briefly refresh memories, a great purpose of having a testamentary trust established, especially if a family has children under the age of 18 that they would like to distribute to, those children were treated as adults for the purpose of tax, and essentially received a tax-free threshold like everybody else, and could then work their way through the marginal tax rates from distributions out of a testamentary trust. What this new rule effectively says is it appears as though that will no longer be the case, and from $1, those minors will be taxed at 30 cents in the dollar. So certainly still more effective than a minor tax rate, and this is where the devil will be in the detail, I suspect, but certainly nowhere near as advantageous as what the current rules allow for.
Yeah, certainly speaking to my estate planning lawyers in the industry, this is throwing a cat amongst the pigeons, I think, really, because a lot of families naturally want their legacies protected in that structure, and there's naturally some tax benefits associated with streaming income to minors that are assessed at adult marginal tax rates. So there's a lot of nuance there that really needs to be thought through in terms of what do you do to plan around that. And so that's going to be an interesting conversation, and we really need to go back to the drawing board with everyone with a testamentary trust will, I think, on that basis there. So in terms of sort of planning considerations, Tracey, what are the sort of key things that we have as a strategy?
Yeah, so for those that already hold family trusts, you should bring into question to a great extent its usefulness and its purpose. And this isn't a quick decision by any stretch of the imagination. It's certainly conversations that we'll be having with all of our clients that already hold the structure. But it's especially the case where income splitting in particular has been the feature of the reason why the trust was established in the first place. A little bit different if the objectives have been around asset protection and succession planning within families. So it does bring into light, there's some complexity that comes with family trusts, and there's compliance costs and needing to deal with the rules and regs, whether it's ATO or ASIC, if you happen to have corporate trustees all in place, that all costs money. So, of course, we're going to consider that in light of the broader objective as well. The concept of potentially restructuring, and so Dermot touched on it briefly, but the opportunity will exist for clients to consider potentially refreshing what that structure looks like. And maybe for some, the notion of introducing the use of a company or perhaps a fixed trust structure could come into play. And so we have, yes, a 3-year rollover relief window from the 1st of July 2027, which will allow, I imagine, some exemption around sort of realised capital gains if that structure or change in ownership were to occur. And how does this interact with the actual capital gains tax changes that we spoke about briefly before? This matters because the proposed minimum tax rules don't sit in isolation. When combined with the separate CGT changes announced in the budget, they can meaningfully alter how effective a trust structure is over time. It's something worth discussing with your apt advisor, so the full picture is considered rather than looking at each change on its own. So yeah, a lot to contemplate, I think.
Yeah, a lot of work for us to do, I think, over that next 3-year period to restructure that. But really, the key takeaways here is that this is going to significantly reshape how discretionary trusts are used by our clients for ongoing tax planning and as a wealth accumulation tool for families trying to build wealth. The trust obviously still has decent benefits around control, succession, and asset protection, but as a pure tax minimisation vehicle, it's really going to be significantly reduced for those that have beneficiaries beneath that 30% tax rate. So that's great to get through the content there, and there's been naturally a number of questions coming through the chat. So we'll take a few of those questions from the audience. And one of them is, should I be thinking about selling or restructuring some assets before 1 July 2027 to lock in the current CGT rules? And look, I think, to be honest, it really does depend. And this is where the importance of working with your apt advisor to model the different outcomes is really important. So I think you need to understand the trade-offs associated with selling and restructuring just to beat the date or just to focus on the tax outcome, because it can really backfire ultimately if the rules are subsequently changed and you end up just incurring tax and transaction costs for no great reason. So I think especially you have to look really at each asset on its own merit and work out, was I planning on owning it longer term? Do I have good conviction in the capital growth prospects, particularly for the property side of things? Are they good quality long-term holdings? In which case you might want to retain them. But if not, then it might be a good catalyst to bring forward those restructurings. And it really does come down to crunching the numbers. So I think the focus needs to be on your after-tax position, both in an annual sense and at the end of the holding period that you intend to own these assets for. So it's become a lot more complex, but I think this is where, working with your apt advisor who can actually understand where you're headed in the long term and understand, the detail associated with this budget and understand your goals and objectives in a really comprehensive sense, that you need to have that holistic approach in that. So, Tracey, there's another question for you, just around, highly geared investment property. Will these changes affect my ability to claim the interest against my salary? And we did touch on that in the negative gearing, but if you wanted to address that in any more capacity.
Yeah. So the key aspect here, I suppose, is that it's an existing arrangement and it's something that is already in place. And if that's the case, then no change. You can continue to make use of those negative gearing rules. A really interesting point that Dermot and I have spoken about is the notion or the stat that both Jim Chalmers and I think Prime Minister Albanese both reference, that eventually they anticipate over a 5 to 10 year period, most negatively geared properties actually become positively geared or a little more neutral. So whether that's because turnover of property will occur and essentially, one property moves from one hand to the other, at which point the new rules would then sort of kick into gear, or just naturally that as debt reduces, properties are much more neutral or positively geared, potentially. Not a bad place to be in terms of a growing passive income stream, which is the conversation that we have with our clients. So the detail is important. Clearly, how long you've held the asset is going to be really critical at this point in time. and to your point earlier, Dermot, we still come back to the core of what is the asset, how is it valued, what type of income prospects do we have, and more to the point, what do we think our capital gains prospects look like as well. So yeah, hopefully that helps answer that question. No change if you're already in that regime. And I'll just touch on one other question that we've had from the audience, which was around whether there would be a change to existing gearing strategies for those who hold shares. And the answer is no at this stage. Shares or the use of negative gearing on any other type of asset, including a commercial property or a share portfolio, is essentially carved out of this new set of rules. So not so ambitious as to completely ditch negative gearing for all, including existing investors, but certainly drawing a line in the sand to say any future use of negative gearing needs to be all about supply as opposed to simply being available to everyone who wants to tap into residential property.
Yeah, good point. We've also got another question here around the trust changes. Do dividends from bucket companies end up being taxed twice? So this is where you've got a corporate beneficiary, otherwise known as a bucket company, that sits beneath the trust and receives trust distributions. So it's not necessarily that they're taxed twice, but they're making you pay a minimum of 30%. So what often happens with trusts is that if there's franking credits that come through from the underlying shares that are owned by the trust that are distributed to that company, then the company can offset some of that tax against the 30% flat tax rate. And the government's saying you can't use your franking credits to pay the 30%. We're going to impose the 30%. So it effectively does reduce the benefit of using those franking credits. They're just going to impose a 30% tax rate regardless. So yeah, good question. It does mean that the effective tax rate on distributions to bucket companies is going to be less effective. So that just needs to be carefully thought through in terms of what mix do you send to your bucket company versus individuals versus other entities, and indeed what assets do you own within the family trust as well? Do you own your big, fully franked dividend income paying shares in the trust, or do you focus it more on your defensive assets? And I think all roads are sort of leading to these types of outcomes that we can sort of massage over the next few years to load up our clients' super with the growth assets, fully franked dividend income paying shares, your small and mid caps and infrastructure and property and those high octane asset classes, and then have more of your defensive in family trusts and corporate beneficiaries and manage that sort of holistic global portfolio. So hopefully that answers that question.
Yeah.
There.
Dermot, I'm going to tap into your expertise here.
Yeah.
We have a question a little earlier around any changes to CGT for non-Australian tax residents on property. So that's, that's a nuanced one.
Yeah.
And it's fairly specific. But yeah, did you want to have a go at answering that?
They didn't specifically mention it in the budget papers, but non-residents on property are treated very differently. So they actually don't get the 50% CGT discount for the time in which they're non-residents anyway. So I think that's probably why they were silent on that, because it wasn't a benefit to them. However, for the principal place of residence, if there's a 6-year rule for those that move, and even if you rent out that place, we can circle back to you on that particular question, whether that's still going to be honoured as part of that. But they were silent on the matter for non-residents. So, but yeah, generally property for the time in which you're overseas, the capital growth is treated very differently to Australian residents. So good question.
Yep.
And finally, one last question is that, do I need to get formal valuations for my property? And the government has confirmed that taxpayers will be required to determine the CGT asset value as at 1 July 2027. So I think got a bit of time between now and then, obviously, but I think it'd be worth getting a line in the sand. What is my valuation and what is the evidence that supports that? Making sure that we've got that on file. Interestingly, they're working on having an online tool where they've got a specified apportionment formula to estimate what that value would be as at 1 July 2027. And this would be particularly interesting to compare notes around what the property valuation comes back at from the independent valuer compared to their formula. But I would be going for the higher one as long as there's good evidence to support that valuation. But they will draw upon presumably data around recent sales in the area, applying reasonable dollar per square meter rates in those areas based on recent sales, and other widely accessible data, I presume, as part of that. But they're going to provide a tool to make that a little bit easier for taxpayers because obviously the cost incurred in getting property values is pretty steep. And maybe the rates of property valuers is going to go up as a result of all of this. So I think, getting those valuations as at that date is going to be really important. So thank you for the engagement for everyone that sent through those questions. It's wonderful. And as you can appreciate, there are many complexities that are thrown up through this budget that really need to be carefully thought through. And this is really speaking to the core of why we offer a comprehensive wealth management service that integrates advice across investment decisions, tax planning, structuring, and succession planning. And that really enables our advisors to deliver more holistic, more tailored solutions that are reviewed more regularly. They generally lead to better outcomes, and they give our clients ultimately the peace of mind that comes from working with a trusted advisor that both understands the big picture and the fine print that we went through today. So if this budget has raised any questions for you, naturally there'll be a lot of different planning opportunities that you'll need to speak through with your advisor. Please reach out to them to discuss that strategy. And with that, Tracey, thank you for sharing your insights today, and thank you to all who joined us. And we hope you enjoyed that webinar. And as I mentioned, if you have any questions, please contact us to discuss further. We'd be more than happy to walk you through what it means for you. And until then, bye for now.